Guys, we had an awesome day. Markets were pumping like crazy, but not everything is well under the hood. We're going to talk about exactly what you should be aware of. So let's dive into this video.
Trade Genius.
Hey, so Phil, this week was actually textbook OPEX trading. So for those who haven't followed us for a long time or just trying to understand, so Operation Expiration Week has usually it is unusual because of the 4-day week, but if the first 2 days of the week start off positive, you can expect a sell-off the next 2 days, which will be Wednesday, Thursday, and then Friday they try to reach back and try to close the open of the week. And we did nearly all that. We kicked open hard on Tuesday, we pumped early Wednesday, and then we fell into Thursday late. Usually Thursdays after Europe closes, maybe around 1:30, always expect and look for a retrace. We got that, and that usually carries into the next day. And we did that too. It was choppy, but then we pushed right through, but we still did not make the open of the week. So you hear a lot of bullish narrative right now, and there is some liquidity, and there's some other reasons why we're getting these moves, but it was still a red week from open to close. And I think, Phil, you're going to probably comment on what I just said too a little bit, but you have some really interesting charts to tell people, hey, don't get the bull picture out of the closet just yet.
Right. I think at this point, it wouldn't be a stretch for the market to come up and grab this double top. Markets, these are weak, what we call weak highs or poor highs. And market tends to like to go back and grab those areas because there's a lot of liquidity back up here. So if the one percenters in this market, the big boys, are looking for like a bunch of liquidity to fill to get ultimately short, that's what they're going to do. They're going to run up there, grab that, and then push back down. There's a lot of stops that are probably hiding up here. And if there's enough juice in the market, we could even get up to this higher level up there near 4,100 on SPX. So there is that. But ultimately, the liquidity will have to kind of show us the way. So we'll be monitoring that as we go forward. But the thing we wanted to talk to you guys about was things that are going on under the hood that aren't so hot. So let's hop over to a couple charts here. We're going to discuss this with you. And you need to be aware just exactly what's going on and how similar conditions in the past created some pretty bearish price action going forward. So first thing I want to talk about, and Bob, we were talking about this earlier, is market liquidity. And real simply, guys, if you look at where the shading stops from that light color to this darker color, you'll notice that on the whole, both the upper graph area and the lower graph area they're shrinking. And what that means is the amount of liquidity in the market, or think of it like market makers have to make a market. And if the market makers disappear, meaning they're not supplying on the offer side of things, they're not supplying on the bid side of things, then you get a lot of volatility because now there's not enough volume in the books to absorb the market moves. And that's why we're seeing a lot more volatility in the markets. And so on the surface, it might look, wow, it's really awesome because the trading ranges are so big. But in reality, you're creating a very unstable situation. And Bob, I think you remember 2018, similar conditions, and you were trading the other part. This plays into the next slide, which is the volatility instrument. And I want to hear your thoughts on that because I know you were trading that quite successfully, and then that whole thing like imploded. You weren't part of the implosion because you're in and out, but can you describe kind of what was going on that led up to that?
Yeah, so what happens is, I was trading XIV at people. That was like my go-to trade for like 5 years. I mean, you couldn't help but make money just shorting volatility. Well, what they did was they pushed it down so hard and so low that they ran out of counterparties. And what happened was then it just took a match to start the Yellowstone fire. And what was really interesting is when XIV blew up, it was 5 minutes after the market closed. And by morning, it was down 90%. And basically, they destroyed that instrument. And so that's where the term Vomageddon comes from, if you ever heard that. Well, we're setting up Vomageddon again. And we had one in 2011. I don't know if you guys remember the flash crash. We traded that too. And we're setting it up again. So what Phil was talking about, the market makers, look, they have very, very strict instructions from their risk offices. And if they think they're going to get caught where they can't broker a trade, look, they don't want to take a directional bet. They simply want to capture a fee for providing a service. And if they think they're going to get captured and to lose money, is that they just keep widening the bands. At some point, they're just going to walk away. They step away. And that's what happened with the VIX. And they're going to step away again. We're seeing it already. We're pushing it down where there's no counterparty here to take on any of the risk that they're offloading. And next thing you know, this guy has a bag of rocks and they're going to fall on him. And I think that's what's going to happen here. And so I apologize. I'm outside today. We're painting inside of my house. So you get to live the drama of SoCal here. So that's kind of where I think we're heading again, Phil. And we just don't know when we're going to do this. This has been our theme. You know, you get these episodic pushes higher, but at some point somebody just walks away, and then you're gonna get the flush down to where there's enough volume for people to be comfortable trading with any kind of size.
Yeah, and again, what happened there on the right side of the chart where it just dropped off a cliff, this is what that translated to. And again, leading up to that, we had a contraction in liquidity in the market. But notice here, this big drop in 2018, that beginning of 2018, and that's how quickly things happen when we get into these situations, and why we're warning you now of just very similar things happening under the hood. The other thing too, guys, that you want to be aware of is that the savings rate right now is really low, relatively speaking, and it's been on a decline since going into COVID. And you wonder, like, how was everybody spending so much money? Well, it's pretty stark right there. Everybody's been running up their credit card debt quite a bit. And right now, it makes what was happening prior to COVID look pale in comparison. Now, the reason why I bring this up is because the savings rate, guess what happens when you put money into a bank in your savings? Well, they treat it as collateral. See, banks have a bank, and it's called the central bank, and they got to post collateral for their operations if they're taking on trades or loans or things like that. So guess what? Your savings is part of that collateral. I mean, that's just the way banks work. So the point here is that they don't have a lot of collateral like they used to have. Going into 2020, look at the savings rate, that huge green spike. That they had a ton of collateral. Now, nothing compared to that, right? So that plays into this next chart I want you guys to be aware of, and that is, this is the Fed's discount window. What is the Fed's discount window? Think of it as an emergency lending window. That's, the Fed's the lender of last resort. If you're a bank, you're in trouble, or you need a quick loan, this is like the pay any day loan at the Fed. And you don't normally see this go up at all, actually. Look through from 2010 to 2020, basically. I mean, it was barely used. Very, very rare. But notice when it is being used. Going into the great financial crisis, it spiked up. Right before COVID, it spiked up and into that COVID crash. So this is a huge warning indicator, probably one of the best ones that we have, that things are not well under the hood. It's not good, and you need to be on your toes. And I know, like, right now, everything seems rosy, especially on a big green day like we had today, which was primarily more a function of OPEX. And Bob, can you explain why OPEX can sometimes do this, even though it's not really like healthy buying? Like, what's going on with that? Can you explain that a little bit?
Well, yeah, it's basically the as the week rolls towards Friday, what they're doing is they're disintegrating the open interest of the calls and the puts. And then when you get to Friday, a lot of times Fridays are fairly quiet. It's basically, you get a rollover. And so when I mean a rollover, it means people that had contracts that were going to expire, they pushed them out into future expirations. And so the market was imbalanced, and they needed to get it back into balance, so it drove it back up. A lot of times, in people who trade with us, especially in the VIP room, will know that I always tell people, look for the cross back into the open of the week. They like to do that, and that's exactly what happened. We opened up around 389, and 396 something was the open for Tuesday, and they pushed it right up to that. And so they just basically got themselves back into balance. And what happens to people, they get recency bias. They said, wow, Thursday into Friday. But people have to understand is traders don't like to hold things short over the weekend. Okay. So they pulled their risk in. So, another little nugget for you guys in your trading books is that if you have a red week going into Thursday after the European markets close, it's a good bet if you go long into Friday close, you're going to make money because they're going to be closing that exposure out. And that's pretty much what happened here this week. Now, normally in the week after OPEC, it's kind of red, but I think we're going to get a little bit of a knock-on effect going into the end of the till for the things that you alluded to, because there's you could talk to people what a poor high is and stuff like that. There's just levels up there to get the books back in balance. And we also had a gap to fill up there too. So, but I want to circle back, if you don't mind, Phil, the chart you had from before. Another reason why the savings rates are collapsing is people are moving their money into CDs. And so that doesn't count in that savings rate number. But that's also bearish for banks, because if you move your money out of their demand accounts and you move it into a CD, they don't get to count it as a reserve.
Right.
And so it causes them problems too. And with, CDs running at 3.5%, 4% now, holding it for a year or two, why would you give the bank money at 0% when you can earn 3 or 4% on your money and do nothing? And so I think that's also bearish, Phil, as well.
Yeah, the point is that the collateral, they just have a lot less collateral right now, and it seems to be stressing the system because, so in summary, while we're bullish, the market liquidity is shrinking, okay, which leads to episodes like this, like Volmageddon, like we got in 2018. And the collateral is going bye-bye for the banks, and we're seeing the Fed discount window start to spike up. So be on your toes here. Don't get lulled to sleep because the market's bullish. And granted, the market could continue to grind into the end of the month. We'll be looking for clues and letting you guys know what we think is going to happen. We'll have to see how next week opens to kind of give us an idea of where the money's flowing. But it's not a place, I think, and Bob would agree, where you want to go start swinging for the fences here, because there could be a considerable downside risk. And keep in mind too, the yield curve is highly inverted. These aren't things you want to be buying long term into.
Yeah, look, the market goes up like an escalator, but it goes down like an elevator, and you can wipe out weeks of gains in one day.
Yeah.
And so, actually, if the market's going up, I'm raising cash out of my portfolios and being prepared for, probably a fairly bearish spring, and then to be able to deploy capital back into the summer again. So that's how I'm personally viewing it. And obviously today was an awesome day on the long side, but you have to realize that this market, when it turns, look what happened Tuesday and Wednesday. Everybody's saying new bull market here, and by Thursday afternoon, people are like, what the hell happened to the market? And that's what's going to happen here. And it's going to then, it could go weeks at a time at this point, because everybody's leaning and trying. And you see the narratives. That's the thing. When you have CNBC and you have social media telling you that new bull market's coming, soft landing, that's when you should be raising cash, not getting more and more leveraged to the long side.
Yep, totally agree. All right, guys. Well, we hope that's helpful. We'll stay on top of these different topics as they progress, and we'll keep you advised. Thanks for watching. Please hit like and subscribe, and we'll see you on the next one. Take care.